We take you now to Washington, where Federal Reserve Chairman Jerome Powell is addressing the decision to raise interest rates. Let's listen in.
In the clause about monitoring developments, and we're going to be watching carefully to see as those things develop. I think more broadly, there's been a sense of concern among business people and market people about global growth. And, that may be partly about trade tensions. It may be partly about a variety of things. If you just mechanically drop into a model of the U.S. economy tariffs, you don't see very large effects. The large effects would have to come from financial market changes or from losses in business confidence, and those are things that are very difficult to model. On your third factor, political considerations play no role whatsoever in our discussions or decisions about monetary policy. We're always going to be focused on the mission that Congress has given us. We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
Applebaum, The New York Times. You're about to undershoot your inflation target for the 7th straight year. Your new forecasts say that you're going to undershoot it for the 8th straight year. Should we interpret the dot plot as suggesting that some members of your committee believe that policy should be in a restrictive range by the end of next year? And if so, can you help us to understand why people would be advocating restrictive monetary policy at a time of persistent inflation undershoots?
Well, we, as a committee, we do not desire inflation undershoots. You're right that inflation has continued to surprise to the downside, not by a lot, though. I think we're very close to 2%. And, we do believe it's a symmetric goal for us. Inflation is symmetric around 2%. And that's how we're going to look at it. We're not trying to be under 2%. We're trying to be symmetrically around 2%. And I don't, I've never said that I feel like we've achieved that goal yet. The only way to achieve inflation symmetrically around 2% is to have inflation symmetrically around 2%. And we've been close to that, but we haven't gotten there yet. And we have not declared victory on that. So that remains to be accomplished.
Okay, Gina.
Hi, Gina Smilik, Bloomberg News. Just following up on Binya's question, I guess if you haven't achieved 2% inflation and you don't see an overshoot, which would be sort of implied by a symmetrical target, what's the point in raising rates again at all?
So again, I go back to the health of the economy. If you look at 2018, as I mentioned, this is the best year since the financial crisis. You have growth well above trend. You've got unemployment dropping. You've got inflation moving up to 2%. And we also have a positive forecast, as I mentioned. And in that context, we think this move was appropriate for what is a very healthy economy. Policy at this point does not need to be accommodative. It can move to neutral. It seems appropriate that it be neutral. We're now at the bottom end of range of estimates of neutral, so that's the basis upon which we made the decision. I also think we took on board, the risks to that, and we're certainly cognizant of them.
Marty, and then Mike.
Mr. Chairman, Marty Kretzinger with the AP. You've established for this coming year a communications panel to look at how the Fed communicates. Could you talk a little bit about what you expect to get from that panel? And will the dot plot be involved in that at all? How do you think the dot plot is working? Are we dealing with it the way that you want us to be handling the dot plot, or is it something that you might tweak a bit?
So this review, what it really is, it's coming at a time when the economy is strong, and it's a good time to take a step back, we think, and ask whether our strategy and our tools and our communications around monetary policy are doing the job that Congress has assigned us to do on behalf of the American people. And what we're going to do is we're going to open ourselves up and have a discussion with many outside groups all different parts of the economy, including an academic conference in June in Chicago. And again, the idea is to listen to new ideas, better ideas, old ideas. Many of them have been around, and try to assess whether there are better ways we can do things. One of the overarching facts is that rates have been really coming down overall for more than 3 decades now. We may be in a world where interest rates are just lower for the time being, and therefore we'll have less policy space to react to economic downturns. And we'd want to be evaluating ideas for, again, for better achieving the goals that Congress has given us. We're not looking at law changes at all, and we're not looking at changing the inflation target, for example. We are looking for better ways to achieve the inflation goal, for example, on a symmetric basis. So that's the sense of that. So as I mentioned on the dot plot, you asked about the dot plot. I think the dot plot generally does provide useful information about the reaction function of committee participants, sometimes more useful than others, I'll admit. But in general, I think people sort of have it figured out and understand what it is and what it isn't, but that doesn't mean we don't like to repeat what it isn't, which it's not a consensus forecast. It's not something that we vote on. It's something that each of us writes down, and we always update it as data come in and as we update our outlooks.
Okay, Mike, and then Edward.
Michael McKee from Bloomberg Radio and Television. The balance sheet reduction, how much additional tightening do you think has come from that? We note in the markets that the cost of credit rising, commercial paper, repo rates, the TED spread widening. Do you see any concerns about the availability or the price of credit that could slow the markets? And if in 2019 we see the economy start to slow, would you, if you don't adjust the balance sheet, be risking too much tightening?
So we do watch all of that, but the amount of runoff that we've had so far is pretty small. And if you just run the quantitative easing models in reverse, you would get a pretty small adjustment in economic growth and real outcomes. So we don't think, things that are happening at the short run, at the short end, are driven by many other factors other than the balance sheet runoff. For example, just very large bill supply has pushed up short-term rates, has pushed up repo rates. Tightening of the federal funds rate has raised short-term borrowing costs. So, we're alert to these issues. We're watching them carefully, but we don't see, the balance sheet runoff as creating significant problems.
Edward Lawrence, Fox Business Network. Thank you, Mr. Chairman. We've seen enormous volatility in the markets recently. We know the president said, don't raise interest rates. That's well documented. The National Association of Realtors chief economist says that it's starting to affect first-time home buyers with the mortgage rates going up. When do you think these pauses need to come in next year? Do we need to keep this, as you say, gradual? And then, in addition, what data are you specifically looking at for you that shows when the Federal Reserve starts to become that headwind in the economy with the rates?
We're watching. We have a strong forecast generally for next year. That forecast involves growth at between 2 and 2.5%. It involves growth at a strong enough level to continue driving unemployment down and inflation near 2%. So that's a pretty positive forecast. So to make further moves, I'll be looking for data that suggests that that's in fact the path that we're on. As I mentioned, once you're broadly speaking in the range of neutral, I think it's appropriate to be putting aside individual estimates of that and be looking at what the incoming data are telling you about the outlook, updating your estimates of what neutral might be, of what the natural rate of unemployment might be, of the state of the economy. So, and letting that lead you to adjust your outlook and therefore your appropriate path for policy. So that's what we mean when we say we're data dependent. Of course, we're always data dependent, but I think it has a particular meaning in this context, which is that.
Go to Victoria and then Anne.
Hi, Mr. Chairman. I wanted to ask, first of all, whether you're worried that President Trump's tweeting and statements might interfere with your ability to communicate with markets and why you're doing what you're doing. And then also I was wondering if you could comment on Governor Brainerd gave a speech recently where she laid out the case for the countercyclical capital buffer being activated. Do you disagree with her analysis? Is that something that you think the Fed should look at doing?
I'm not worried because on the first question, because I know, and everyone who works at the Fed knows, that we're going to do our jobs the way we've always done them, and that involves, getting the best thinking together, diverse perspectives. Every business cycle, every FOMC cycle, we talk to hundreds of people in all different parts of society, not just business people or market people, but people from community development organizations. We get survey data from thousands of people, and so we really do have a pretty broad exposure to what's going on in all different parts of the country, and we're going to take all of that information in, and we're going to make the best decisions we can, and nothing will cause us to deviate from that. In terms of the CCYB, so the CCYB is a countercyclical capital buffer is a tool that allows us to build capital at a time when vulnerabilities, financial stability vulnerabilities, are meaningfully above normal. And so that's a tool I'd be absolutely willing to use and happy to use at such time as that test is met. We meet and discuss that and evaluate it on a roughly.
You've been listening to Federal Reserve Chairman Jerome Powell discuss the decision to raise interest rates for the last time this year. We've got much more news ahead. We're watching the big board there. We'll have more on that as well. You're streaming CBS App.